The Federal Reserve is making loans cheaper. The federal funds rate is currently around 4.11%. By the end of 2026, this rate is expected to fall below 3.5%. Wall Street is excited, but middle-class Americans aren't likely to benefit much from this decline in interest rates.
Low rate and high liquidity environments benefit the guys who have money in markets, benefit the guys who already have the wealth.
The top 0.1%, they have seen their wealth nearly double since 2020 to over $23 trillion. Stocks accounted for virtually all of that growth.
Most Americans own stocks. However, older and wealthier Americans generally own more of them than everyone else. As a result, they benefit from the asset price booms that tend to follow Fed rate cuts.
Individuals who were exposed to the private equity market, the private credit market, they've been able to just make bank.
It's really important to own financial assets. If you have all of your money sitting in a savings account, odds are after time, you're going to find yourself being stretched more and more thinly.
As the Fed gears up for a rate cut, we ask, are they helping or hurting the typical family? The cost to borrow money will likely fall over the next year, according to the Fed's forecast.
We do have a very good sense of the direction the Fed wants to head in, and that is lower rates. If you look at the Fed projections, maybe we're looking at closer to 3% of an overnight rate in a couple of years, and that really sets the floor for all other interest rates.
Lowering this rate sets off a series of chain reactions in the economy. For example, your savings accounts may earn less money on interest after Fed rate cuts. That said, you also might pay less interest on your credit card debt. These moves also create conditions that can make it cheaper to finance cars, student loans, homes, and more.
It really is sort of a flywheel for all other economic activity. And that's why you start to see, I think, financial investors get excited for lower rates.
When you're spending a lot of money on interest costs, you're not spending it on things that are actually useful and productive. They're able to deploy that money and keep it for internal investment, capital expenditure, hiring.
But there are downsides. This process tends to lead to higher wealth inequality.
The Fed's easing cycle could unintentionally widen the generational wealth gap, lifting the net worth of retirees, baby boomers, while the 20-somethings and the 30-somethings who depend more on their wages and capital gains not benefiting as much.
We see that it does not benefit everyone equally. If you are an Apple or any great big corporate borrower, you will see a difference from 0.25% rate cut because you've got the best borrowing costs on planet Earth, basically. So you will see that benefit. But when it comes to things like automobile loans and credit card rates and even mortgages, it takes longer for them to filter through, and it takes more of them to make a real material difference in what it costs for average American working men and women to borrow.
Younger households are hurt most by a reduction in interest rates. That's because they own the smallest share of financial assets.
What happens when the Fed overnight rate come down? We ultimately start earning less money on cash, which makes it less attractive versus other investments. So it's really natural to think about, where do we want to reallocate that capital?
Take, for example, real estate.
In a lot of markets, real estate has become, and in some cases, unaffordable.
Qualifying for a mortgage today requires a six-figure household income in most of the US. That's far above the median household income. The income requirements are higher if the buyer doesn't have a 20% down payment ready. Compare this to conditions from 2006. The median household brought in around $58,000 that year. They needed $54,000 to qualify for a mortgage.
Years of zero rates and quantitative easing drove housing prices far faster than incomes. It rewards older and cash-rich households, but it locks younger buyers out.
When compared to real estate, stocks generally require less capital and deliver higher returns over the long run.
Real estate money can be a little harder to place. I would argue that if you really want to reap the full benefit of real estate ownership, you're doing it in private markets. And that is generally a little harder for people with smaller portfolios to get into.
For these reasons, many Americans are flocking into equities like stocks,
2025 is on track to see a record $1.25 trillion flow into exchange-traded funds. The strength of passive investing has never been what we're witnessing right now.
Families lower on the income scale tend to have more of their wealth tied up in real estate and durable goods. The wealthiest families in the country have significantly more wealth tied up in stocks or mutual funds.
If you look at your average boomer right now, stocks have been very good for them over their lifetime. Most of the wealth in America is in that generation in stocks.
The S&P is at near all-time record highs and risk appetite is on. That pushes people from equities. It's like a waterfall. That's why private credit, private equity, alternative markets are so booming. People are looking for uncorrelated assets to hedge their risk assets. That's why you're seeing frothiness in the alternative space, frothiness in Bitcoin, in gold.
That is a direct impact of some of these zero interest rate policies, which intentionally try to raise and inflate asset values.
Wealth inequality is rising globally, much of it due to structural factors like globalization and technological change. But central bank decisions play a role too.
We've seen the Gini coefficient rise here in the United States over time. This is an economic metric that we use to look at this dispersion of wealth. It tends to be very high in developing nations and tends to be lower in developed nations.
Fed policy has been instrumental in taking the baton from what had been just educational inequality, and now it is also inequality driven by monetary policy. And the Fed has to be very careful about how much it lowers the cash income that retirees are making on $7.5 trillion of record money market funds right now. And you would never want for them to be in a position where they say, you know what, I'm not making enough on my retirement assets, getting cash off of my savings, I better sell some of my stocks.
The U.S. central bank did more than make loans cheap during recent crises. They also bought trillions of dollars in Treasury securities, the traditionally safe investments. This makes their yields fall, which makes buying safe assets less lucrative. Experts call this process quantitative easing. You can see the process unfold on the Fed's balance sheet. When the balance sheet increases, the Fed is spending money to support the economy.
They grew their balance sheet from $4 trillion to $7 trillion in the space of 3 months. That was the Fed injecting historical, biblical amounts of liquidity into the system to smooth the market functionality at the time because markets completely seized up. But then it kept on buying more bonds long after the financial markets had stabilized. And that is where a lot of the criticism comes from. It's the Fed staying too long and keeping the liquidity pumping into the system for so long that it's just in the end going to benefit very few.
And the result of that was inflation, which disproportionately affects the lower resource population, an asset boom, which disproportionately benefits the upper class and effectively puts pressure on the young people and the lower income households.
With the clarity of hindsight, we could have, and perhaps should have, stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risks.
The Fed started to reverse this process in 2022 as it tightened economic conditions to fight inflation. And in the summer of 2025, they signaled that they're going to pause this tightening of the economy. In October, Federal Reserve Chairman Jerome Powell signaled that this tightening would end, even as inflation remained above their target rate of 2%.
There is no risk-free path. If we ease too aggressively, we could leave the inflation job unfinished and need to reverse course later to fully restore 2% inflation.
I think in both the great financial crisis and COVID, both scenarios we have these zero interest rate policies, it was out of necessity, a real concern that the economic engine might grind to a halt. There are trade-offs to that. I don't foresee that even though we're cutting rates, that we're going back to zero interest rate policies, barring some, global calamity again.